Hey, what's going on, everyone? Good morning. Good morning. Here from the city of Riverside, actually in the city of Paris, California. But it's great to be with you all. As you can tell, I am testing a new microphone. The last time I made a video that I went live, I actually just did not have a microphone like this. And I hope that it's making a difference because I do see here that I see the audio going up and down, and that is a great sign that the microphone it is seems to be working. I was testing it a little bit while ago, but I just was not having a lot of luck. But anyways, the point of my video is not for me to make a review. It is for me actually to just come on board, share with you a little bit about what is happening in our economy. As you can already tell by now, I'm a big fan of what's happening, and also with Fed Reserve now announcing today that they will be raising interest rates. How is that going to affect the overall economy? How is that going to have a play in how we do business, how we go about our personal lives, and how is it that we actually spend our money, right? Because by raising interest rates, it will have an effect on how you decide to spend your money. And so I wanted to go over with you a little bit of some of these articles that I have here. I still have not figured out how is it that I can show you to share my screen, and one of you is going to have to leave me a comment and let me know how I could do that. But in the meantime, I will read you a quick article that was posted by the Wall Street Journal just earlier today. And again, it's interesting, but again, looking at this chart that I'm looking at, if we go back to 2001, I want to say 2001, we saw that interest rates were around 5.5, 5.7%. They slightly started to go up. When we hit the brief recession in 2002, right before 2003, that was obviously right after 9/11, we saw interest rates go up to 6.5%. So what happened after that? We were in a recession. Okay. When we are in a recession, the economy has to stimulate. They have to stimulate. We have about 25 minutes actually before Fed goes live and starts to go over the details. But anyways, my point is that when we're in a recession, interest rates start to go down. So we saw them going down during the recession in 2000 all the way to 2005. We saw the big jump again that we experienced in 2000, and obviously right before the Great Recession. The interest rates were around 6.5 again, 7%, but they went down, right? They went down, and we brought them down obviously because of the reason of stimulating the economy. So now, with that being said, if I may share something with you, is stagflation. Now, you all know what inflation is. That is when the prices of goods start to go up in price. We normally typically see it around 2% every single year. Well, obviously, that tend to varies depending on the year, depends on on what's happening in the economy. Okay. But stagflation, let me tell you what it is. It's a mix of stagnating growth and rising prices. It has been generally viewed as a relic of the 1970s, because in the 1970s we saw prices started to go up, interest rates started to go up, but economists are warning it could be making a comeback. So what is stagflation? Stagflation, the term is broadly defined as a sluggish growth tied with rising inflation. Okay, something what we're experiencing right now. The term was widely used in the 1970s when U.S. consumers lined up to fill their cars with high-priced gasoline at jobless rate hit 9%. 9% was the overall unemployment. Okay, and then cars, the gasolina prices was way up there. So you saw people lining up at the gas station so that they can get those cars filled up. Stagflation spells trouble for the economy. Rising stagflation erodes consumer purchasing power, and weaker demand hurts companies, profits, and causes layoffs. So, as you can see here, it will weaken the profits and it will cause layoffs. And then obviously, it will have an effect on purchasing power for the consumer as well. We're experiencing that already. If Fed Reserve decides, which they will raise the interest rates today during their meeting, which is about to start in about 25 minutes, you will start to see that the purchasing power for the consumer, especially in the real estate market, we're starting to see that already, where the prices are very high and interest rates are starting to go up. So what's happening? One thing that I'm personally seeing is that with interest rates starting to go up, the consumer starts to lose purchasing power with their home. So now if they raise them up right now, they're hovering around the 5.5, 5.3% on average if you have a good interest rate. But if they raise him up again, that will definitely take him up to the 6%. That in turn, on a $500,000 house, it's going to have an impact of a couple $100. When somebody says, "Hey, I'm going to go buy a house," they don't say, "Hey, I'm going to go buy. I can only afford a 6% interest rate house, or I can afford a $500,000 house." We don't say that. We typically say how much in dollars per month we can afford. So if you say I can only afford $2,000 a month, and that was giving me a purchase of $350,000 at a 3% interest rates, I'm just throwing numbers. But now interest rates are going up and prices are going up. I can no longer afford that house at $2,000. Now my purchasing power starts to reduce, so therefore I can afford less of a home. So now no longer 500,000, $300,000. It's less, especially with interest rates going up. Also, stagflation also puts the Federal Reserve in a blind because the central bank's job is to keep both inflation and unemployment low. Okay. So stagflation is going to put the Federal Reserve on a hot seat because their job of the central bank is to put both inflation and unemployment low. So now guess what happens if you raise interest rates? The consumer is not going to be able to spend. So therefore, what's that going to translate to? It's going to translate to companies making less profit. Why? Because consumers are able to spend less money. The consumers we're getting squeezed as it is right now already. Yesterday I went to go fill up my gas tank. I have a Yukon. Obviously, I have a big truck, but almost $200 it took me to fill it up. $200. I remember when I was budgeting about 2 years ago, I was budgeting $400 a month. 450 was like, babe, we need to slow it down. What are we doing? $450 now today. There's no way we can make it with $450 2 years later. We're budgeting anywhere from 700 to 700, sometimes even $800. And it's not like we're traveling, all over the place, or it's not like we're going to big places. I mean, we're just going literally 15, 20 miles away from where we live to our jobs. But just gas prices, I mean, you're starting to see to come down a little bit, but we are obviously still seeing them at an all-time high. And obviously with interest rates now going up the way that they are, very interesting. Again, I wish that I could find a way for me to share what I'm seeing, but hopefully you can follow along. But the Fed can raise interest rates to curb inflation. Okay. The Federal Reserve can raise the interest rates so that they can curb the inflation, meaning that they can put a cap to that so they can bring it down. Obviously, by depressing spending, hiring, and investment. The stock market this morning actually went up today, um, obviously because of the Federal Reserve raising their interest rates. Okay. A path it had started on and intends to continue this year, but it moves very aggressively. It risks tipping the economy into a recession, meaning that the tipping we already experienced 2 quarters in a row of GDP negative gross domestic product. So we are in the negatives. So obviously, there's still got to review the numbers. But as I take a sip here of my Bulby, I love sparkling water. Um, so we're gonna review the numbers to make sure that the second quarter aligns with the numbers that was given. Obviously, we were in the negatives, so we are getting very close to the government finally announcing that we're getting into a recession. Okay, that is the word of the word of the year. Okay, going back to early March, early February, even at the beginning of the year, that is the word of the year. Do you remember in 2020 what was the word that we used the most? That was obviously pandemic. Pandemic was the word of the year that year. Today, 2022, recession, it's the word of the year. So why is stagflation is a risk now? Okay, annual U.S. inflation is at a 40-year high, no question about that, 9.1%. And parts of the economy are cooling interest rate as interest rates rise. Got that? So as interest rates continue to go up, the economy is going to start to cool off. One of the areas where I can tell you that I can see that it's obviously in the real estate. I am involved in real estate. That is what I do. That is one of my professions, aside from another business that I run. But we are seeing more inventory starting to pile up in the market. Okay. Not so much that sellers are finally deciding, hey, let me go ahead and put my house on the market. Not so much of that. It's more of a, I can't sell my house. And why is that? Because we're seeing a lot of sellers denial. Sellers denial means that, from what I've experienced, if a year ago I was able to sell my house was worth $500,000, I will go ahead and go tell my realtor, hey, you know what? Go ahead and put it on the market at um, go ahead and put it on the market at 530,000. Let's see how much more I can get. So 530,000, I will put it on the market. The buyers will come in and then they would say, hey, I can go ahead and let me go ahead and sell it at, you know, I'll offer you 20,000, 30,000 over asking. But now we're no longer seeing that. We're no longer in a seller's market. For all of those buyers out there that were waiting for an opportunity, this may be an opportunity that's starting to open up, but that is what's happening. We're starting to see that. So home sales, here it goes. Home sales have fallen in recent months. Consumer spending growth has slowed and job gains have lost stream. Okay, since the start of the year, there's been a lot of companies. Yesterday, Shopify announced that they were going to lay off 10% of the 10% of their workforce. They were gonna lay them off, and they actually are going to do that. Tesla has announced as well that they're going to be doing a 10% layoff as well. Facebook has already projected that they're going to be hiring slow for the remaining of the year as they continue to prepare. Now, I met not too long ago with one of my good friends who owns a company. He owns a construction company. They are in charge of not just building brand new communities, okay, but they're also build bridges and roads on the freeway. A lot of infrastructure. They already have seen a decrease in their field by 40%. So what have they been doing now to prepare themselves for next year is that they have been scheduling smaller jobs, meaning that they smaller contracts. So the contracts that they were doing this past couple of months, this past couple of years were pretty big. Obviously, they are forecasted 6 months up to a year in advance. So if they are not able to see that the demand is going to be there, what are they going to do? They have to adjust. Just like any leader, just like any chess player, just like any basketball team, any soccer team, any whatever team, right? They have to adjust because they are able to see the play that is ahead of them. So with them is they have been scheduling fewer and smaller projects because they are preparing for what is coming. Okay, supply chains remain disrupted by the war in Ukraine. Obviously, as we already know, Ukraine is one of the world's largest importers in wheat and corn. Okay, and production problems relating to the COVID-19 pandemic. So, very interested what the hike of interest rate would mean. Federal Reserve, obviously, like I said, they're expected to raise them today. It will make it more expensive for consumers to borrow money for everything from cars and homes and refrigerators. Typically, a family and my sole job here in this YouTube channel is for me to go ahead and provide the value in the sense that I can go ahead and give you, perhaps, let's just say, a way to make you aware that consumer debt is not always the best thing. Okay. Now, when you're investing and you're leveraging the debt, like Grant Cardone or Robert Kiyosaki, then that's a whole different story. Using the debt that's going to produce you more cash flow, more income, not using it against you. So the wealthy know how to use that, but the average individual, the average family, does not understand that basic scenario. So what do? They go ahead and use debt for their own benefit, which is either purchasing a refrigerator, getting a car loan. Home might be a little bit different. You can get away with that simply because typically mortgage loans, they go on 20 to 30 year. Obviously that just depends on whether you have the income or not. It's very interesting that you can make that decision based on your needs. But anyways, uh, obviously, rate by Federal Reserve raising the interest rates, it's going to mean it's going to have some type of effect. Got it. So that is what we're seeing. That is what we will be experiencing as soon as they announce, which I believe they're going to start very very shortly here in a little bit. So actually, we got the news now. Okay, we got the news. The Federal Reserve continue a sprint to reserve its easy money policies by approving another unusually largest interest rate increase and signaling more races in the coming weeks to combat inflation that is running at a 40-year high. Officials agreed on Wednesday to a 0.75 percentage rates interest rate raise, which will lift the benchmark federal funds rate to range from 2.25 to 2.5%. The rate increase won anonymous backing from 12-member rate setting committee. In a policy statement after the conclusion of their two-day meeting, officials acknowledged signals of a lower economy activity since they met last month. Obviously, they already know that we're seeing a slow in the economy. An economy cannot continue to just keep going like this. It's unsustainable. Eventually, what goes up, it has to come down. So we have been seeing a lot of like this just up since 2017, 2018, especially after the government came in and bailed everybody out. In a policy statement after the conclusion of their two-day meeting, officials acknowledged signs of a lower economy. Got it. Okay, recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months. Okay, the statement repeated a language from previous meetings. Okay, they've been talking about this in previous meetings before. That said, officials anticipate additional rates will be appropriate, meaning that they will continue to raise the interest rates, the benchmark interest rates, in the upcoming months. Fed Chairman Jerome Powell is set to speak to a news conference at a 2:30 p.m. Eastern conference. So that's going to be in about 10 minutes. That is going to be very interesting what he will have to say. I wish that I could go ahead and share my screen with you all so that we can go ahead and see when Fed Reserve Jerome Powell starts to announce that they're going to raise the interest rates. Now, I got to make sure that I got my speaker well set here because, again, I just got this microphone. I just got this microphone not too long ago, and uh, I'm just learning to use it. I hope that you guys all can hear me. But hey, thank you all for joining today and being here with me. But we've been on 18 minutes already, just going back and forth. But Fed Reserve, just this is breaking news. It just came in. Fed officials are raising interest rates at the most aggressive pace since the 1980s, ladies and gentlemen. As I take another sip of my Bulby here, sparkling water. Fed officials are raising interest rates at the most aggressive since the 1980s. Now, that just goes to show you how aggressive they are in order for them to taper down the inflation. Obviously, 1970s, 1980s, we saw inflation hit their all-time high of, in the 10s, 15s, 19%. Today, we're seeing it around 9.1, obviously the highest that we have seen it in 40 years. And they have been approving increases out of 4 consecutive policy meetings starting in March. They have raised the interest rates 4 times already since they have announced back in March that they will start to do so. When they lifted rates from near zero until last month, the central bank hadn't raised rates by 75 basis points since 1994. Okay. That just goes to show you how aggressive they are. They have not raised interest rates by 75 basis points since 1994. And they have done that four times already this year. Four times in April, May, June, July, and 4 months. That means that every month they have been raising it for what? 75 basis points. They have not done so since 1994, almost 30 years ago. That again is a signal that where our economy is standing at right now and how desperate they are for them to bring down the inflation. Obviously, they are not going to tell us that we are in a recession, but obviously we are more certainly in a recession right now, and there's no denying, there's no denying for that. We're just waiting for the numbers to come back once again so that they can tell us exactly what they are. So as I look at here, with Wednesday's actions, the central bank has raised rates since March as much as it did in 2015 and 2018, and returned the funds rate to a level since then. 3 years ago, before a slowing economy led the Fed to cut rates slightly, officials slashed them to zero in March of 2020, meaning that after the pandemic started, they slashed interest rates to zero in order for them to be able to stimulate the economy and get that going when the COVID-19 pandemic raced around the world. Okay, got it. U.S. inflation has accelerated since March of 2021. Since March of 2021, demand surge after the economy reopening, aggressive government stimulus, and Russia's invasion of Ukraine has further aggravated supply chain disruptions and driven energy and commodity prices this year. With the war in Russia and Ukraine, it will have an effect, obviously, around the world. Even though us as the United States were not particularly involved with what's happening out there, it does have an effect in the world economy. Um, Again, the European nations, they raised their interest rates by 0.50 basis points. I think it was 0.5% about 2 weeks ago, about a week ago. They have not done that since I don't know how long ago, but it's been a while since the last time they've done it. But again, the inflation for us accelerated since March of 2020, when obviously the Fed Reserve lowered the interest rates to near zero in order to stimulate the economy. So interesting what will happen. Very interesting what we're going to see as Jerome Powell makes his video here in a little bit. But going back to a chart that I was showing to you earlier, very interesting that it caught my eye. It was actually I lost it here again, but it was just how interest rates were up during the recession. You can see during the recession, Fed Reserve starts to lower interest rates down. But before recession, they have to raise the interest rates up. Okay. So now a lot of people are saying, are we gonna see interest rates going down next year? It could be. It could be as we enter the recession. It'll be very interesting to see how they will go ahead and stimulate that economy. But anyways, just quickly wanted to share this with you because it is something that will affect obviously all of us. It will affect, it will have an effect either positively or negatively. It does have an effect, but again, it's up to you to make your own determination. Obviously, not being very naive about it and understanding, accepting the fact that we are, in fact, in a recession will help you understand that we can make those adjustments, we can make those moves as we continue to move forward, as our economy continues to trend in going from what it is right now into perhaps what it could be, a recession. Anyways, with that being said, thank you guys for joining me today. I wanted to share a little bit of value with you, and I will be going live every Wednesday so that I can share with you a little bit more, whether what's happening in our economy or whether something interesting that we're seeing today in our world. It doesn't have to involve business. It could be anything related. what may happen out here in my state of California or in the state of Florida, which is where I'm going to be moving in 2024. Very curious to see how the market is going out there, how the real estate market is. It continues to bloom. Obviously, they saw one of the biggest migration coming into their state this past couple of years, and so I'm curious to know how the Florida market will continue to operate. But with that being said, I'm gonna get ready to listen to Jerome Powell here in a little bit and talk about his decision making in joining. I'm sorry, in lifting up the interest rates. But with that being said, thank you guys for watching, and we'll see you on the next one. Can't wait for you to see the next video that I'm gonna make that will come out next Monday. So stay tuned for that one. Take care, guys. Bye bye.